Hi, my name is Sean. I'm a founder and CEO of Business 101 Publishing. Thanks for joining our first interview. Today's interview is brought to you by Business 101 Publishing. I'm with Joseph Wang, the author of Central Banking 101, and Inyuk Kim, the reporter for Korea Economic Daily Global Division. I read the original version and reached out to Joseph a few months ago, see if he's interested in publishing a Korean version. And we excited to have Central Banking 101 Korean edition published this month. And this book takes a deep dive into how central bank and the Federal Reserve work. And I'm sure it'll be helpful read for Korean investors, especially considering everyone has been keeping eyes on the Fed and the interest rate for the last couple of years. Can you introduce yourself for Korean readers and what made you decide to write Central Banking 101?
Well, first of all, thank you very much for inviting me. I'm very excited to have a Korean version of Central Banking 101. I have a Portuguese version and two Chinese versions as well, and they do very well. So I'm sure this would be of interest to the Korean audience. So first, I'll talk a little bit about why I wrote Central Banking 101. So I have always been very interested in financial markets. I see the markets go up and down every day, and I want to know what drives that. So I began my career in 2008. So that was a time when the financial markets were very turbulent. Every day, it seemed like the world was going to implode, and the next day you could see the stock market soar. I was very curious as to what drove that, and it also seemed like there was a lot of money to be made in understanding this. But what I realized when I was researching, just what was happening, it seemed like a lot of what was driving what happened in the stock market was what the Federal Reserve was doing. And when you actually read what people were talking about back then in 2008, you would come away with very different perspectives as to what the Fed was actually doing. Some people, for example, at that time, that was the beginning of quantitative easing, would say, you would print all this money, you're going to have hyperinflation, it would be very bad. And other people were say that, that's not how this works. So I realized that it was very difficult to actually understand how the financial system worked and how the Federal Reserve operated because there were so many different types of information. Now, ultimately, I ended up working at the open markets desk, which is the Fed's trading desk in New York City. And from there, I had the opportunity to basically sit at the center of the financial system, the Fed's trading desk, and be able to really understand just how the Fed operates and how the markets work behind the scenes. Because when you are at the Federal Reserve's trading desk, you have access to a lot of confidential data and you were able to talk to market participants throughout the world. So we would talk regularly with foreign central banks, with other large investment funds, with commercial banks, with everyone. And when you spend time on the open markets desk, you are able to get a glimpse behind the curtain that other people don't. And I really developed a much broader perspective on just how the Fed operates and how the markets work. And I wanted to share that with the audience because this is really the book that I wish that I was able to read back in 2008 when I was beginning my journey in studying the markets.
Thank you. Can you explain what Federal Reserve is? What are the roles of the Fed for the overall economy?
Yeah, the Federal Reserve is the central bank of the United States of America. What I've noticed just looking at markets is that what drives markets the most is the actions of central banks. And among central banks, the Federal Reserve is the most influential. For example, recently we've seen markets rally a lot, and a lot of that has to do with the perceived rate cutting cycle that the Federal Reserve may be embarking on. So being able to understand the Fed is really important in trying to have a view as to whether the stock market will go up or down. Now, the central bank of the US, of course, its responsibility is not the stock market. It has two mandates. The first one is price stability, and the second one is full employment. What that means is that the Fed will try to make sure that inflation rises at about 2% a year. Not more, not less. That's what they think of as price stability. The second thing is full employment. It wants to make sure that everyone who wants a job can get a job. Now, this is a target that would change over time because sometimes, for example, as the population ages, maybe fewer people want to work. So it's always a difficult thing to figure out just what is full employment for the US. Now, these two mandates sometimes are in conflict. For example, if inflation is very high, the Federal Reserve will try to raise interest rates to slow the economy down. That would make inflation move lower, but it would also increase unemployment rate. So for the Fed, there's always some tension between these two mandates. And it's a judgment question. Right now, for example, we have inflation that is a little bit too high, but we have unemployment that is really low. So the Fed feels comfortable in keeping interest rates elevated, trying to balance its two mandates. Now, the way that the Fed tries to carry out its tries to meet its mandates is through its tools. Its primary tool is controlling overnight interest rates and its balance sheet. So when you're hearing the Fed raising or cutting rates, what they're doing is they're adjusting the overnight interest rate. Now, the Fed thinks that when you adjust the overnight interest rate higher, that slows the economy down. For example, maybe you are a business and you are trying to borrow money to make an investment, but because interest rate expenses are higher, maybe you will do less investing. Or if you are a consumer and maybe you wanted to buy a TV, but you saw interest rates were much higher, maybe you would delay your purchase a bit. So the Fed thinks that toggling the overnight interest rate affects economic activity. Now, the other tool it has is its balance sheet. The balance sheet is basically when the Fed creates money and goes out and buys longer dated treasury securities or other assets. The Fed does this also in an attempt to influence interest rates. In this case, when they go and buy, for example, longer dated interest rates like the 10-year treasury, they're hoping to put downward pressure on interest rates. So the Fed is always thinking about impacting economic activity through the lens of interest rates, and it deploys either the overnight rate or its balance sheet to try to adjust that.
Can you also explain about the repo market? Why is the repo market important for investors?
Yeah, the repo market is the largest and most important market that you have never heard about. So let me actually give you some idea as to the size of the repo market. The repo market is basically when you borrow money and you put treasury securities down as collateral. For example, let's say I have $1,000 in treasury securities, but what I really want is cash. So then I can take my $1,000 in treasury securities and then go and put it down as collateral and borrow cash against it. So in a sense, it makes the treasury market very liquid. So let me give you a sense of the absolute size of the repo market. So the cash treasury market, so everyone thinks about the US treasury market as the deepest and most liquid in the world. On average, every day, the cash treasury market volumes are about $700 billion a day. The overnight treasury repo market is about 1.5 trillion a day, 1.4 to 1.5 trillion dollars a day. So it's much larger than the underlying cash treasury market. Now, this repo market is very important because it makes treasury securities money-like. It makes it very cash-like. So you can think of it as, for example, if I have, let's say, $1 billion or $10 billion of treasury securities, and I can always take that and I can either sell it in the cash market or either borrow against it in the repo market. This makes it easy for me to raise liquidity, and it also makes treasury securities a lot more attractive as an investment. In a sense, it enables the US government to spend tremendous amounts of money through deficit spending and have a lot of people willing to hold treasury securities because they're so liquid. It can also be used as a market for leverage. For example, if I wanted to speculate on a direction of Treasury securities, I could also buy a Treasury security and fund it in repo. And so in that sense, it's like taking on a margin loan and trying to bet on Treasury security price appreciation. So overall, I think of the repo market as both a market for leverage in case you wanted to have a levered up exposure to Treasury securities, or if you already own the Treasury securities as a way for liquidity. So you can basically easily convert Treasury securities to cash, increasing your willingness to hold it.
Great, thank you. Question 4 to question 9. That's about the interest rate and the capital markets and the current economic situations. And Enof's going to take those questions.
Yeah. But before the question, I want to say thanks to Joseph for writing this book, because as you said, it was the book that I wished I had before starting my career in global economic department. I bet Korean readers will find this book really helpful.
Thank you.
So,
Thank you.
yeah, I want to start the question about the current economic situations. When do you think the Fed will start cutting rates, and how many rate cuts do you expect this year?
Well, that's a very important question. And so I think I'll first describe why the Fed is going to be cutting rates, and then what the Fed says and what's been in the market. So on the one hand, so just thinking back the past 2 years, we had inflation very high. At one point, year-over-year inflation in the US, measured by CPI, was about 9%. Now, 9% is far above the Fed's target, and so the Fed increased interest rates aggressively. So now, though, over the past year, we've seen inflation steadily come down and gradually approach the 2% inflation target. We're not there yet, but we're getting very close. Now, the Fed looks at the world through the lens of real interest rates. Real interest rates are nominal interest rates minus expected inflation. So as nominal interest rates have gone up to about 5.5%, inflation has gradually trended lower. That means that real interest rates are gradually rising. So the Fed, if real interest rates are gradually rising, even as inflation comes back to target, now that doesn't make sense, because what you would be doing is you would be making monetary policy even more restrictive, even as you get closer to your target. Now, the Fed doesn't want to do that because it's afraid that it would eventually over-tighten and push the economy into a recession, threatening its other mandate, full employment. So the Fed is looking at inflation coming down towards target, and it wants to cut nominal rates to make sure that the real interest rate doesn't actually increase. So in a sense, from the Fed's perspective, cutting interest rates going forward is not to ease monetary policy, but to make sure that it's constant, to make sure that real interest rates continue to remain about where they are. So in December the past year, the Federal Reserve had a dot plot where it suggested to the market that in 2024, it would cut rates about 3 times. Now, since then, now that's what the Fed is telling you, but the market, of course, has its own viewpoint. And over the past few weeks, we've seen the market be very volatile in what it's pricing in for the Fed. At one point, it was pricing in 7 rate cuts in 2024. Today, it's pricing about 4 to 5 rate cuts for this year. The reason being that economic activity has come in stronger than expected, and inflation data has been pretty hot the past month. So that suggests that maybe inflation is not going to go smoothly to 2% as expected. And so the market is being a bit more hesitant, thinking that maybe the Fed is actually not going to cut as much as 7 cut times this year. Now, my base case is that the Fed cuts 3 to 4 times this year, because even though inflation seems to be rising a little bit in January, we've still done a lot of progress towards 2%. The path towards lower inflation is still well established. Now, we may not get there. There are a lot of things that are making the economy have structurally higher inflation that we can talk about. But even if inflation remains between, say, 3 to 4% going forward, the Fed would still cut rates just to make sure that the real interest rate doesn't rise too much, so that they won't over tighten. So my base case is about 3 to 4 cuts this year, and I think that's in line with what the Fed has communicated in December.
So you mentioned 3 to 4 times this year, and that's more conservative perspective than the market before. So what is the reason behind that?
So I think the market is very optimistic as to how quickly inflation can come down to 2%. Now, if inflation really does quickly come down to 2%, then I think the market would be correct. We would have to cut not just 4 times, maybe 5, 6, or more times. But there are big structural factors that are driving inflation higher, such that I think that it's going to stay higher than the market expects. Now, the biggest factor that I think is keeping inflation high is the fiscal spending. So right now, the United States is spending about 6% of GDP in deficit spending. The Congressional Budget Office recently published a forecast and suggests that the fiscal deficit in the US will remain above 5% of GDP for the foreseeable future. Now, this is a very, very big change that's happening. If you go to the US 20 years ago, you will see that the US government, there were many people who were worried about the fiscal deficit, and there was a lot of political discussion to try to make it smaller. In fact, in the 1990s, the US actually had a fiscal surplus. That means that it received more in taxes than it spent. But those times are gone now, and what we have is what we've never ever had before, a structural fiscal deficit that just goes bigger and bigger as far as the eye can see. Now, one of the things that I talk about in my book is how Treasury securities are basically a form of money. If I give you, for example, $1,000 in treasuries, it's very much like giving you $1,000 in purchasing power. You can't use it to buy food at a restaurant, but you can sell it and get cash, or you could borrow against it. It very much increases your purchasing power. It's a type of asset. So the fiscal deficit that goes larger and larger into the future is basically a form of money printing. Now, when you have money printing to the extent, let's say, about $2 trillion a year, it's going to be very difficult to get inflation back down to 2%. So if inflation is stuck between 3 to 4%, as I expect, then I think it's very difficult for the Fed to cut rates, more than 4 times this year.
So you mean the structural government deficit is one of the reasons why that inflation is going higher than longer?
It's going to be stuck, I think, between 3 and 4% going forward. When I look at the future, I think that the future will be very different from the past because of these structural changes. One of them, of course, is the fiscal deficit. So that's not something that has happened before. And we've already seen in 2020, 2021, what large fiscal deficits can do to inflation. What I think the market does not understand is there's this big structural change that will continue to have an inflationary impact on the economy.
I think that's really interesting perspective because everybody thinks that US economy is holding really well compared to the other continents, but you're saying that's because of the government deficit, not the sustainability of economy. So is that one of your answer about why US economy is holding up very well, or is that a different answer?
It is definitely one of the reasons why the US economy is doing well. If you have the government spending so much money, I think it's very supportive of the economy, and it's difficult to see how the economy could fall into recession. But it's not the only thing that's happening. As we're looking across the world globally, for example, in Europe, you obviously had some geopolitical concerns, particularly with energy, that's putting a downward pressure on their growth. If you look to Asia, a lot of it is related to China, and we know that China has some issues in its property market. So there are some country-specific things that are happening in other countries that are impacting their economy that we don't have in the US. But one of the positive things that we do have in the US that's being very supportive of economic growth is an amount of fiscal spending, and that looks like it's going to continue. So I don't expect the U.S. economy to fall into recession. It's honestly, I think significant amounts of fiscal spending is going to be very, very positive for the U.S. economy going forward. Now, it's going to put upward pressure on inflation, but it's going to be good for economic growth. And if you look at the GDP numbers over the past year, you'll see that the U.S. economy continues to grow above trend and surprise a wide range of market observers. Recently, of course, we grew above 3% the fourth quarter, and I think that's above trend, and I think a large part of it is in part due to fiscal spending.
That's really insightful, and I want to ask more about that perspective. So, what do you think about the driving force behind the structural change? What is making the government spend more?
Yeah, that's a very important question. So I'll give you an overview of how the U.S. deficit is structured, and I'll tell you why that it kind of has to go up. So in the U.S. budget, there are three types of spending. One of them is what's called mandatory spending, and that is things like Social Security, which is retirement benefits and medical benefits for senior citizens. The second point is called discretionary spending, and in discretionary spending, about half of that is military, and the other half is everything else that ranges from education to government salaries. Now, the last part of the spending is interest payments. So if you look at the mandatory section, so the section that is benefits to senior citizens, it can only go up, because the US, like many countries throughout the world, is having an aging population. And as more and more people age, you're going to have more people looking for retirement benefits. You're going to need more medical care, and medical care is also getting more expensive. So that mandatory section of the fiscal budget, it only goes up. Now, the second part, second part I'll talk about is interest expense. As we know, the US government is issuing a lot of debt, and interest rates have gone higher. It looks like we're not going above zero. So interest expense is only going to go up too, right? Larger stock of debt, higher interest rates. So those two things are structural, and they're only going to go up. And there's really nothing you can do about it. In the US, the senior citizens are politically very powerful. And if you tell them, I'm going to cut your benefits, you will not get elected. So those two things are only going to go up. Now, the third thing is called discretionary, and that's military, and that's everything from government salaries to education. It is possible for discretionary to go lower, but when I look at what's the politics, I don't think it will happen. When I look across the world, for example, we have more military conflicts in Eastern Europe. There's talk of the Middle East, and of course, there's concern about things that are happening geopolitically in East Asia between, say, China and Taiwan. So it looks like there's more interest in military spending because there's going to be more military risk. Now, military spending, if you look at a timeline, goes up and down with geopolitical conflicts. It was very high during the Cold War, then it came down. It was high during the Iraqi war in 2000, and then it came down. Now, if we're heading into a world where more geopolitical instability, the military spending has to go up as well. Now, this part I'm speculating on. The interest expense and the mandatory spending, that's can't change that. This is the discretionary part that can be changed, but I don't think will be changed. Now, the other part that I would note is that in the US, it's becoming more and more popular to talk about spending for climate change. Now, this is very popular in Europe and other parts of the world, a little less in the US, but becoming more popular. More recently, Biden passed the Inflation Reduction Act, which was essentially a huge subsidy to try to support climate change initiatives. So if climate change becomes more popular, and it looks like it will, then people are going to spend a lot more money to try to make a green transition. So that's more spending as well. So I think going forward, the fiscal spending is just going to continue and get even larger.
If I sum up your argument, that aging population and the geopolitical situation and climate change all works as a inflationary pressure, right?
And higher interest rates, of course. The
Higher
higher
interest
interest rates means the government is going to have to spend more to pay interest.
Then, is there no any other negative outcome of that too much government deficit? Because, in general, government deficit is not a good thing,
So government deficit in the modern monetary system is basically money printing, because if I give you $1,000 in treasury securities, I'm giving you a financial asset. I'm giving you purchasing power. So if you continue to print a lot of money, yes, it is not positive, but it is also not the only thing that matters. Now, for example, if a smaller country, maybe Brazil or maybe Mexico, maybe Argentina, would conduct tremendous fiscal deficits, their currency would depreciate and you would see a lot of inflation come quickly. But those are smaller, medium-sized countries. The United States is very lucky in that it is large and it has the reserve currency. So it has a lot more room to do this, but the room is not infinite. So I think what is happening going forward in the coming years is that more and more investors will see that the US is not being well managed, and that would have implications on both the value of the dollar and with inflation as well. I don't think the market fully sees that yet, but the US is not on a sustainable path, and it's on a path towards away from prosperity.
What about the possibility of recession? I think you mentioned a little bit about that, but can you illustrate
I
it a
think
little bit more?
Yeah, so many people have been surprised, as we discussed, on the resilience of the US economy. I think the thinking was, and this includes what Chair Powell was thinking, we were going to hike rates really high, we're going to cause a recession, and inflation will go back down. And they did hike rates very high, and there was no recession, and unemployment remained very low. So the question is, why? Now, I talked about one of the factors that it has to do with significant fiscal spending. I think the other factor is that there are structural changes in the US economy that make it more resilient to interest rates. So high interest rates don't have a big of an impact on the US economy for a couple reasons. One is that in the US, unlike anywhere else in the world, the vast majority of households have debt that is 30-year fixed for their mortgages. So the largest debt for US households is their mortgage, and it's 30-year fixed, and almost everyone started borrowing, refinance their home in 2021. So on average, the typical interest rate is below 4%, and honestly, it's probably close to 3%. So even as the Federal Reserve hikes interest rates, that 30-year fixed rate interest doesn't change. So households are not affected by it. They're insulated from it. Now, the second thing, when you look at the corporates, well, in 2021, 2020, the corporations were feeling that there was an existential crisis, and so they termed out their debt and they borrowed a lot of money. So they haven't really needed to refinance their debt, so they haven't really been subject to higher interest rates. So even though the Fed raised rates a lot, it hasn't had a very strong impact on the economy. So I think that's another reason, in addition to fiscal spending, why the US hasn't fallen into recession. And as fiscal spending continues, I think it's unlikely that it would fall into recession this year.
I think it is a nice timing to bring up the question about the commercial real estate's problem. John was about to ask this question. Is it okay if I ask it right now?
Please go ahead.
Yeah. So what do you think about the influence of the commercial real estate in the economy?
So commercial real estate has been in the headlines a lot, but I am not worried about it. And I'll tell you why. So commercial real estate, we have to know that it's a very broad category of assets. So commercial real estate includes multifamily, includes hospitals, includes industrial, includes data centers. It includes many things. And each of those subsectors have their own fundamentals. Now, broadly speaking, commercial real estate is doing fine, except for office and except for retail that's in major office centers. Now, because of work from home, so in the US, it's very popular for companies now to allow employees to work from home. But if the employees are not going to the office, then the company doesn't want to pay as much rent. And so the office sector is not doing well. We've heard in the news that there are some banks that have exposure to office sectors, and those banks are being punished. Now, how this would work is that if you are a commercial bank, sometimes you give a loan and you back that loan. That loan is secured by office property. And it's possible that because the office property depreciated so much in value, that the bank is subject to potential losses on the loan. And so that's been a source of concern. So this is a problem that is going to affect some smaller banks, but it's not going to be a very big problem for the banking sector. The Federal Reserve did a study on this, and they found out that in the US, we have about 4,000 banks. The biggest banks that everyone has heard of, these are called GSIBs. They include JP Morgan or Citibank or Bank of America, have very, very small exposure to this office space. Now, if you go one level lower to the major regional banks, they also have small exposure to the office sector. But when you go one level lower to the smallest of banks, thousands of banks that no one has ever heard of, there is some more exposure to that. And so there are going to be some small banks that are not going to do well, but it's not going to be a systemic issue. It's going to be some few small banks that no one has ever heard of, maybe getting merged into larger banks, but I don't think it's going to have an impact on the banking sector as a whole or the US economy as a whole. Now, I would also note that many banks have had over a year to be able to work through these problems. And if it's a problem that everyone sees and they can prepare for, it's unlikely for it to be a serious problem.
So just want to comment on the commercial real estate sector. Actually, I was going to ask you that question because construction companies and real estate developers in South Korea, they cannot feed the projects because they're not able to extend the existing loans, and that's what's happening now. And eventually, most of them are underwater, and the banks have problems too. So I guess that really depends on the reasons, because South Korea is such a small country compared to the United States. But you don't think it'll have an impact on the broader market this year?
So I would say that when you look at real estate, very broad category, you have residential, you have commercial, and within commercial, many different types. The office space in downtown centers, let's say San Francisco, is going to have very big problems because of work from home. But looking beyond that, broadly speaking, I think real estate looks good. Now, I would look, for example, at residential real estate in the US, single family real estate. If you look at the stock of the home building companies in the US, you can say Toll Brothers, D.R. Horton, Pulte, they're going to the moon. They're going around all-time highs, even though interest rates have gone up, because people are still, the US consumer has jobs, wages are growing higher, and they have a lot of wealth and they want to buy homes. So it's really going to depend on your sector. The office space sector and real estate, commercial real estate in city centers is not doing well, but everything else seems fine from my perspective.
Do you mean that commercial real estate problem is not a systemic issue in United States banking system because it's very limited to small banks?
Yes, let me give you an example. So recently we had New York Community Bank have a lot of trouble. Its stock price basically halved in a day because of commercial real estate. But when you look at what the problem, though, it's very specific to New York Commercial Bank. It had a lot of loans backed by multifamily real estate in New York City, and there was a recent law change in New York City that makes it more difficult for owners of that real estate to charge market rents. And so that legal change made the buildings a lot less valuable. And so that made New York Community Bank have a lot more credit risk. And New York Community Bank also has a lot of loans backed by office space in Manhattan, which of course is not doing well. So it seems very much that you have this bank that has a lot of exposure to sensitive sectors of real estate. And it seems very isolated to banks like that rather than something that is systemic.
Yeah, so I want to bring one more question regarding that, might be related to the commercial real estate problem. At January FOMC statement, Fed stated that the United States banking system is sound and resilient, and the market assumed that has something to do with the Silicon Valley problem, and that paragraph and praise was removed from the statement. Do you have any reason for that?
I think that they are very, very mad that New York Community Bank had to announce earnings on the same day as that statement. So that statement was put in, of course, in response to the turmoil we had in the last March in the regional banking sector. But then also note, for the past several months, we had heard nothing in regional banks. Everything seemed okay. So it looks like the Fed felt comfortable enough to take that line out of the statement and just kind of put the regional banking turmoil behind them. They were thinking that this is all over. We don't have to put that in the statement anymore. And just as they did that, we had some problems with New York Community Bank. So it looks like a very unfortunate coincidence. I think what the Fed did is take that statement out to try to show that this is not something worth thinking about anymore, that the crisis is behind us. After all, they are also winding down the special BTFP facility that was intended to help the regional banks. So even as they are moving beyond this, it seems like it flares up just a little bit.
Thank you. I want to move on to the questions about the stock market. And the stock market last year recorded high, and it went beyond 5,000. So what is your expectation about the stock market this year?
I think this year will be very, very positive for the stock market. At a high level, when you're having significant amounts of deficit spending, in a sense, you are depreciating your currency. So as you depreciate your currency, you would expect financial assets to appreciate. And I think that's what's happening. Now, I don't think this is going to be a straight line, and there will be times of volatility. But I think as long as the deficit spending persists, I think the stock market is going to go much higher.
Is there any number you're thinking?
For this year, I think we can easily go up another 20%. So we get close to 6,000 on the S&P 500. And now, again, many things can impact this, but we have a good economy. We have the Fed that is going to cut interest rates, and we have fiscal spending that is expected to be very large going forward. All these things are very positive for the stock market. In my personal research work, I told my readers in December of last year that we were going to have a very positive stock market, and it looks like it has gone straight up since. I think it's too hot right now, but I think this is going to be a good year for it.
How does the U.S. elections affect the policy decisions and stock prices this year? You name so many other factors driving the stock market higher, but do you think also U.S. election has to do with the stock market?
I think it can. So I'll step back and say that now We think of the Federal Reserve as an independent part of the government, but historically speaking, the Federal Reserve is always related to politics to different degrees. Now, if you go back a few decades, we had President Nixon, who had his Fed chair, Arthur Burns, and he would tell him that, I hope that you come to your decision independently, but I hope that you independently decide that my conclusion is the right one. So, the amount of political influence that is on the Fed changes over time. The past couple decades, the Fed has been relatively independent. But I think we're moving into a world where the Fed is going to be less independent. Now, let me point to an op-ed written by former New York Fed President Bill Dudley in Bloomberg in 2019. Now, President Dudley said that, I think that Mr. Trump is very dangerous, so I think the Federal Reserve should conduct policy to influence the election. So I'm getting the sense that that even though the Fed would like to be independent, there are many people in the government who would like to influence the election because they really don't like one of the candidates. And so it's possible that the Federal Reserve may try to have some impact on the election, but I don't think it would be very large. So to that extent, I would think that it would bias them towards a little bit more rate cuts than usual, because historically speaking, if the stock market is doing well, if the economy is doing well, it's good for the current president.
Should I buy S&P more? Should I get it more?
It's already a lot. Yeah.
Yeah.
But I would also note that, so the people who make decisions on the FOMC, they are appointed by the President of the United States. This past 2 years, President Biden has made a lot of appointments on the Board of Governors at the Fed. And so I think that's made the Fed a little bit more dovish than usual. And by that, I mean that they value having low employment more than having low inflation. And so I think that also maybe makes the Fed more interested in rate cuts.
At the market, there are people saying that it is a good time to lock into the high bond yield, and it is a nice timing to buy bond. So if you compare the bond and stock, which one would go better this year?
I think bonds are going to do terrible this year, and I think they're going to do terrible for the next several years. In the market, everything is always supply and demand. Now, if you have a government that continues to issue, let's say $2 trillion in bonds a year, there's no way that is going to do well. As supply goes up, you're going to need to have lower prices to attract the next buyer. So that means yields are going to go higher. Over the past 30 years, we've had a very big bond bull market. Bond prices continue to go up, interest rates continue to trend down. I think that's over. That's over because we are heading into a world where there's higher structural fiscal spending, and that's both inflationary and it increases the supply of bonds. So I think stocks will do much better than bonds this year and for the foreseeable future.
Right.
So last question is about the currency management. After that, we gotta wrap this up. I enjoyed the reading chapter 5, interest rate, and I appreciate the coverage of the topics related to interest rates from the foreign central banks, and you explained very well how the currency swap trades work across the different countries. So there's a growing number of investors in South Korea investing U.S. equities using Korean won. And benchmark interest rate set by Bank of Korea, which is a central bank in South Korea, is 3.5%. So, 5.5% is a current federal funds rate. And let's just make assumptions that, you're Korean investors and you're thinking about investing in the U.S. equities with the Korean won. what stance would you take given the current rate environment and the stronger dollar against the KRW?
Yeah, that's a good question, especially from the perspective of a foreign investor. When you go and invest in U.S. assets, it's not just about whether or not the stock market will go up or not, but there's always also a currency dimension. For example, maybe you are a Korean investor, you buy the S&P 500, S&P 500 goes up 5%, but if the currency if the currency, the dollar depreciates 5%, well, then you don't really do that well, right? So there's a couple ways around this. One of them is to try to hedge your currency risk using an FX swap. Now, the downside to that is that it costs money because interest rates in the US are higher than they are in, say, Korea. And so in order to have that currency hedge, you're going to have to pay some money. But of course, by paying that money, you get to hedge your currency risk. However, another way that it seems like it's becoming more popular for foreign investors is to just buy US assets unhedged. Now, unhedged exposes you to currency losses, but it also exposes you to currency gains. So when I look at the chart, it looks like the dollar is appreciating against the Korean won over the past few months. Now, in that case, let's say you were a Korean investor and you bought the S&P 500, the S&P 500 went up and the dollar appreciated, so you're winning on two sides of the trade. It's like a double play. It is more risky, but it has been a winning trade. Now, because I think that the U.S. Economy will remain stronger compared to many other economies, and so interest rates will remain relatively higher than other countries, I feel comfortable that the dollar will, if not continue to strengthen, at least not weaken. So one way to think about this is that you can invest in U.S. assets, but either just not fully hedged so that you can benefit a little bit from that potential dollar strength.
Great answer. Thank you. So we gonna wrap this up today. Thanks for the time, Joseph. Where can we find you online? Like I know you're active on Twitter. Can you talk about the what you're doing in these days and where can we find you?
So I do have a lot of things that are public facing. Of course, I'm on Twitter. I also have a YouTube channel called Joseph Wang, where every week I give you a debrief as to what happened in the financial markets. I also have a research service called fedguide.com, where on a weekly basis I publish my thoughts on the market. So the YouTube, of course, is free, but the weekly research pieces do have a very small subscription fee.
Thank you.
The fedguide.com is the
Yeah.
website.
Okay, got it. Okay. All right, thank you. I'm gonna press stop, so give me just 1 second.
Finished? Can I ask you one just last question? There's something between official question and private question. So the argument that aging population is inflationary that you had makes me think of the book that I've been recently reading, the Great Population Reversal of Charles Goodhart. Do you know
Goodhart, yes.
about the book? Yeah.
Yes, that is where I learned this view from, and it makes perfect sense to me.
Yeah. So I've been thinking of current situation, that high inflation situation. Can I explain it with that viewpoint of Charles Goodhart? And you gave me the answer about this, so I think that was really insightful and great. Yeah, thank you for that.
Absolutely. So I think Goodhart's view that an aging population increases the dependency ratio is brilliant, and it makes a lot of sense. Now, I think, for example, in the US, what if tomorrow half the people retired? Well, I think that would be very inflationary because who's going to do all the work? Who's going to go? Half the people retired, they have to go to restaurants, they continue to live, continue to enjoy life.
Yeah,
But that means there's a lot less people working. And
yeah,
that means labor goes higher, labor prices go higher. And so I think we see a lot of that happening in the US already. Now, in 2020, in the US, something that very strange happened. and that a lot of people retired early. Now, the Federal Reserve estimates that about 2 million people retired earlier than expected. So the labor force suddenly shrank, and what did we see? We saw wages rocket higher and still remain high. And so higher wage growth was in part contributing to higher inflation. And I think we'll continue to see that. Now, it's very difficult. Now, on a global scale, I think it was more difficult to see this because internationally, the supply chains are intertwined. So, for example, when Japan was aging ahead of everyone else, you didn't see as big of an impact because at that time, China was still increasing their working force population. But we're heading into a world where everyone in the world, in the Western world, is aging, and even in large countries like China. And so I think there's going to be a global decline in the working population. And I think that's going to put upward pressure on labor. And of course, it's going to, as Professor Goodhart mentioned, have upward pressure on inflation.
Yeah. With that perspective on the Korea must be experiencing the highest inflation pressure from now on because we are in a very low birth rate and working force is going low. So yeah.
Where are the people going to, I mean, where's all the labor going to come from, right? When you're old, you don't disappear. You continue to live, you continue to consume goods and services.
Yeah, thank you.
Okay, I'm gonna press the stop recording button here. 1 second.